Hello and welcome to Market Matters presented by MyX, and we're going to go into a journey of the world of volatility. I am Joe Teague, former options market maker, and from the chaos of Volmageddon to today's market anomalies, let's discover the strategy shaping today's financial landscape. In today's big story, we're going to unravel the secrets and risk of Volmageddon 2.0. Now, Bob Farrell's in his 10 rules of investing, he said exponential rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. But before we get into that, let's go into the weekly preview. We're going to start it right off here with the economic reports of the week. Nothing going on tomorrow. We got the flash PMI and manufacturing retail PMIs tomorrow. That should be moderately interesting. Thursday, the GDP, that's going to be a big one. Jobless claims, something we're watching very carefully to tune in on interest rates. And of course, more inflation data. We got the PCE data coming on Friday with home sales, another potentially market moving event. As far as earnings of the week, there is a lot of earnings going on this week. We're going to trade Netflix. We traded Tesla last week. Brian had a put protection strategy for his long stock. We're going to trade Netflix. This is a big week for earnings. Is really jump-starting the earnings week. There's a lot of big names this week. It's going to set the tone for the rest of the tech stocks. Of course, Tesla and Netflix are really critical earnings reports that we'll be watching. Let's go to the investor sentiment. This has been trending more neutral lately. It's nothing flashing any major red flags here. We had that 52-week high right at the end of the year. That was potentially a sign that bulls were offside. We had a little hiccup, and really the markets rebounded nicely in the last week, keeping on going higher, being led by the semis. Believe it or not, and we're dipping back into fear. Or greed here. We're dipping back in here, saying the people are looking at this market, really excited to get back in here. Remember, investors, more retail money comes in at the top. We'll see if that comes into play. But this fear and greed index by CNN is something that I like to watch as another contrarian indicator. We are at lofty levels here. People are looking a lot more greedy than they have been lately. And we also have been watching the CME FedWatch tool here. This actually took a big move last week. We were maybe like 25 basis points lower on all these for the year end of 2024. Now we're looking maybe 5 or 6 cuts. Last week it was 6 or 7 cuts. So it's amazing the market has been able to stomach this adjustment. We've been talking about how the market and the Fed, which is their dot plot, they've been off. The Fed saying 2 or 3 cuts. The market stomached that adjustment last week, continued its grind higher. Really good news for the market. And then remember, talking about volatility, talking about seasonality, we're coming into February and March, 2 of the more volatile times of the year. Let's keep that posted. But without further ado, let's jump into the big story. And, you know me, I'm Joe Teague. And yes, I'm the charismatic media personality. I'm known for insightful insights on volatility, and I bring a unique perspective to the table. But before I was on TV, I spent years as an options market maker in the S&P and the VIX pit in the tumultuous period of 2007 to 2011. Now, this was an extreme time of volatility. This shaped my experience. And the S&P pit at the time was the world's largest open outcry pit to be trading in. Just by myself. There were teams of traders. I was trading there on my own. Now, I transitioned from market making. I became a portfolio manager. I specialize in managing long volatility for clients seeking to hedge their risky assets. Now, one standout moment of my portfolio managing career came in 2018, February 5th, 2018. Remember the 5th of November. On that day, I held the single largest futures position I'd ever managed in VIX futures. I saw its value surge by over 100% in a single day. And this rise of volatility, now people want to know what happened. It was just a really complex day, a lot of things going on, but essentially people were way too piled into this short volatility trade. It was a short squeeze into a stop limit order with a short squeeze, which led to the contracts being up over 120% on the close. Now, this sent shockwaves through the financial world, resulting in significant changes in the way the volatility is traded and held in these ETFs. Now, one thing I noticed last year, though, is something strange has been going on in volatility. And let's just take a look at the spike index versus the SPY here over the past 2 years. Now, if you remember in 2022, at the start of the year, we saw a 11.5% decline. And with that, we saw a spike index rise close to 40. It was about 39 on that peak there. So we had a huge spike in the spike index. Last year in October, another volatile time of the year, we saw the S&P 500, the SPY, down 9.7%. Yet we only saw the spike index go up to about 24. So what is going on? Something different is happening here. And in reality, what's going on here is there is a absolute explosion, a surge in option selling ETFs. So they are just booming out there. There's a QYLD, there's the JEPI. There's a ton of new strategies out there to just want to collect income using options. Now, if you go back in time throughout the eras of volatility trading, my partner, Luke Rubari, he was a specialist on one of the largest pits in the SIBO in the 90s, the .com era. And the way firms treated volatility at that time was, well, I'm just going to trade my way out of it. I'm going to buy stocks low, sell stocks high. I'm going to take advantage of volatility that way. And that worked very well during the .com boom era. But you can imagine stocks don't always go up. The buy the dip doesn't always work. And following that crash of the .com, the new prevailing wisdom was, we need to have tail risk. The Nassim Talebs of the world were out there saying, buy puts, buy tail risk. We need protection to the downside. Well, that became extremely expensive. Now, this worked to my benefit as a market maker in the S&P pit and the VIX pit. My partner, Brian Stutland, an early adapter to VIX options, came in there, take the other side of this trade, happily selling tail risk, collecting that premium. It's a great spot to be in as a market maker when you have your opponent, your opposing party wants to lose on that trade so that their other trade remains safe. So this was just known over time to just lose money consistently. And by the time 2008 rolled around, well, wow, you didn't get anything for owning this tail risk because the decay of owning these options was just so costly. You wiped out all of your gains in 2007 that you would have potentially had. So flash forward to now, where now the new thing post the Bernanke put is to say the way to use options is to use it to collect income. Now, the first way had its flaws. The second way had its flaws, as we can see. The third way isn't going to turn out to be an event that will have its flaws. We'll wait and see. But one thing I can say for certain is it is a very attractive time right now to be hedging with long volatility. Volatility is suppressed, as I discussed earlier. It's suppressed because market makers know orders are coming into that pit. They're going to be selling volatility. They're going to sell volatility ahead of it. They want to have short volatility on their books so they can buy it back at a lower price later. That's keeping volatility low. Now, at some point, this will unwind. If the market has a sharp correction quickly, some of these big banks, these financial institutions will have to unwind some of these trades. This might lead into exasperating these losses. So that is the trade of the day. If you want the big story, if you want more on that, if you want more info on that, if you want a way to trade that, I encourage you to check out equityarmor.com. Look at some of our strategies. We have long volatility strategies, which take the opposing side of a lot of that volatility selling trades. So let's go to the trade ideas of the week. Netflix, I mentioned, has earnings coming up. It has been in a fantastic run since it broke down in 2022 here. Had a bad earnings event, and we're getting very close to where we were on that breakdown. We recovered basically all of those losses there. We're right at the top of this trend line. I am a little nervous. Now, if you look underneath the hood here on the volatility surface, we're seeing that the implied one-day move is about 7.5%. The average move is actually 10%. This seems like an attractive time to buy some volatility, especially looking for some protection to the downside. So I'm looking at Netflix currently. It's at 486. I'm looking at buying the Feb 16 regular Feb expiration, 485 put at 2180. I'm going to sell the 450 put. That's a $35 put spread. That is about a 7.5% move, just like the market makers are pricing in. So I'm anticipating a market maker move. I'm going to pay almost $13 for this. I can close to double my money if it does go all the way down to the bottom there. So that is what I'm looking at in Netflix ahead of earnings, just some protection. I think volatility is a little bit cheaper than it could otherwise be. And I am very happy to put some protection on into earnings. Let's move on to the question of the day. Last week, Brian traded Tesla, put protection strategy. He was just looking at this chart saying, oh, we got some lower highs here. 220 seems to be a magnet. Brian's trade was to buy the 220, 200 put spread, pay 630. That can turn into $20, of course, max profit of almost $14. Right now, ahead of earnings, that trade is gone Brian's way. It's almost $11 now, so he's got a $5 profit here. What would Brian do here? Is he going to be taking it off? Is he looking at a way to protect this trade, to lock in these gains? I think Brian put this on because he's protecting his long Tesla stock. I think he's going to keep it on just because of that. If he wanted to adjust it in any fashion, maybe he can sell an extreme downside put just to collect some of that profit that he's made on that. But, maybe a downside put spread, something like the 170, 150 put spread could be in order. But that said, I think Brian is happy that he's up money, but he's going to stick through it through earnings because he is still protecting his stock on that trade. All right. And we will be moving it into options 101. Options 101. What are option synthetics? Ever heard of option synthetics? Well, it's a powerful strategy combining calls, puts, and the underlying asset to replace a different position. Why bother? Well, for options traders with complex positions, it's a seamless way to manage risk. Plus, it's a savvy move for those looking to protect concentrating stock holdings without triggering a taxable event. Now, let's consider a synthetic long put. Now, remember, any synthetic long position is going to take the long of the opposing option position. So a synthetic long put is going to include a long call. A synthetic long call is going to include a long put. So a long put is a long call plus a short stock. You can visualize it here: long call, short stock, that balances each other out into the long put. Beautiful. And synthetic short call is a short put plus short stock. Short put, short stock is a short call. Now, it can also be used to create the underlying position. As I mentioned, you can use options to create stock. So a short call plus a long put is synthetic short stock. Short call, long put. You can see how the call and put move opposite directions. Put them together, and you have short stock. That is options 101, how to utilize synthetics to create positions. I'm Joe Teague of Equity Armor Investments. This has been Market Matters presented by MyX. Remember, please like, subscribe, send in your questions, tweet me, share this with everyone. Really glad to have you here. Really fun show to do. If you like what you see, get it out there and spread the word.